Hi, and thanks for joining me in the Credit 101 course. This training was developed based upon the fact that they don't teach this stuff in schools. So we have to teach it to our children, and I have a bunch of kids, and so I kind of wanted to put this out there so that my kids and your kids and you can all learn what credit is, how it affects us, how to build it or repair it, and then some budgeting things to help us along the way to financial freedom. Good credit is a very important aspect of a lot of people's life decisions, our major decisions. It's required to obtain loans, keep low interest rates on credit cards, purchase a home or a car. It also helps you to save money on insurance, utilities, and even cell phone services. But establishing and maintaining a good line of credit isn't always easy, and it's important to understand what it takes to build strong credit because credit hasn't been around very long. So maybe the older generations didn't really have a clear grasp on it, and so they haven't really taught the younger generations how to use it effectively and wisely. So, credit scores. It seems like we're talking about them now more than ever. Where to get them, how to track them, the best ways to improve them. But why is your credit score so important to so many lenders? What does it tell them about you? And how does it help them make decisions about what kind of loan you might be approved for? Or if you're even going to receive one at all? I'm here to try to demystify credit worthiness in the eyes of some lenders and break down the different credit scores so you can feel more prepared and less confused and perhaps a little less frustrated when you try to apply for a loan. Credit scores are going to tell most lenders how likely you are to repay them. Think of your credit score as your financial report card. When lenders pull that credit report, one of the things they look at is your credit score or your grades, so to speak. And based on how high or low your number is, they can estimate how much risk you present as a borrower. So instead of A's, B's, C's, and so on, your three-digit credit score is grouped into the following categories. This is also known as your credit score scale. So you have poor, fair, good, very good, and excellent. And while these categories are going to differ slightly between the two main credit calculators, FICO and the Vantage score, they're generally just going to fall into the following ranges. So the Vantage is going to be a 300 to a 600, whereas the FICO is a 300 to a 579. Fair is going to be a 601 to a 660 for the Vantage, and 580 to 669 for the FICO. To have a good score for Vantage, you're looking at a 661 to a 780 and a 670 to a 739 with the FICO. FICO is the only one that has a very good score, and that's going to fall in the range of 740 to 799. And then to have an excellent score, Vantage is a 781 to an 850, and the FICO is an 800 to an 850. And where your credit score falls is going to tell many lenders a lot about your financial history. And while it's not the only factor that determines whether or not you're going to get a loan, the loan terms you receive, um, it's going to be a really important factor. So like I was telling you earlier, FICO scores were introduced to lenders over 25 years ago. They've become the best known and most widely used credit score. But a lot has changed since lenders first started using them in 1989. I wonder, my mother never taught me about credit scores. They happened right after I was born. Lender credit granting requirements, data reporting practices, consumer demand for credit, and consumer use of credit have all evolved since then. So to help lenders make more informed credit granting decisions and to help ensure you get access to the credit that you need, the FICO score model has been updated periodically over the years. So, for example, we use credit a lot more frequently than we used to. FICO scores have been updated to reflect this change in our behavior. And if we didn't, the seemingly normal credit usage would be considered a higher risk than in years past. The result is that multiple FICO score versions are available, and in addition to the most widely used version, which is the FICO Score 8. That's the one that you're going to see if you log into Experian.com. So as you can see here, different places are going to use different scores. So for auto lending, credit card decisions, mortgage lending, newly released versions, etc., different lenders are going to use different credit scoring models. So when a new FICO score version like the FICO 10 or the FICO Score 10T is developed, FICO releases it to the market, and then from there, each year, each lender is going to determine if and when it's going to upgrade to the latest version. Some lenders will upgrade quickly, while others may take longer. This is why some lenders are currently using different versions of the FICO score. Other FICO score versions, including industry-specific auto and bank card versions, are also included in the FICO score products on myfico.com. So you can see what most lenders see when they're looking at your score. So if you're financing a new car, you're going to likely want to know your FICO auto scores. This is the industry-specific scores used in the majority of auto financing related credit evaluations. If you're applying for a credit card, you want to know what your bank card score is, or the FICO 8, because many of those versions are used by credit card issuers. And then if you're purchasing a home or refinancing an existing mortgage, you're going to want to know the base FICO score versions previous to the FICO 8, because most of the lenders don't use the FICO 8 for mortgages. And then for other types of credits like personal loans, student loans, retail credit, you're going to want to know what your FICO 8 is, because that's the most widely used by the lenders today. What credit report information do most credit lenders use to make their decisions? This is a question I get asked a lot. So when lenders pull your credit report from the top 3 credit bureaus, which are Equifax, Experian, and TransUnion, they're going to be able to see much more than where you just fall on the credit score scale. They're going to review a variety of things. Most importantly, they're going to look at if you pay your bills on time. So lenders want to know that you pay your bills on time. They also want to know if you have any accounts in collections or if you've declared a bankruptcy. There's a reason why payment history is a whopping 35% of your FICO score. The more responsible you are with the bills you already have, the more likely you're going to be responsible with a new one. And how much credit you're using. This is also known as your credit utilization ratio. Lenders like to see that you haven't used up all your available credit and you have the least amount of debt as possible. So for example, if you have a $5,000 credit limit on your credit cards, it looks bad to lenders if you're already using $4,000 of it. A good rule of thumb is to keep your credit utilization at 30% or less. So if you have a credit card with a $300 limit, try not to spend more than 30% of that each month, or $90 of that each month. They're also looking at how long you've had your accounts. That's 15% of your credit score. That credit card that you've had for years and years can really be a good thing, especially if you've had a great payment history. The length of the time that you've had the account in good standing, as well as the diversity of your accounts like auto loans, mortgages, credit cards, etc., that looks good to lenders because it demonstrates that you have a history of responsible borrowing with a number of different creditors. But keep in mind, they're looking at the average age of credit history. So if you've had a card for 10 years and then you get a new one, the average credit history length is now 5 years. So you got to keep that in mind. So to get this positively affecting your credit, the length needs to be 7 years or more. And then 10% of your score is new lines of credit. It's going to bring that score down until your first payment, and that's because you now have a higher amount of credit available to you. It's going to bring down your credit utilization. Um, that's why it's going to help increase it. Another 10% is that credit mix that I was just talking about. You want to show a variety of credit, not just 5 credit cards, but some mix, like a car loan, a mortgage, a credit card, and a personal loan. You can look your best to lenders by keeping an eye on your credit. So, no matter what type of credit score you have, it's important to keep track of your credit report so that you can not only be approved for loans, but you can get the best rates for repayment. So, as mandated by the federal government, every U.S. citizen is entitled to one free credit report from each of the 3 credit bureaus each year. You can find that by going to annualcreditreport.com and ordering one from each of the 3 bureaus. It's a great way to prevent unwelcome surprises and work your way to excellent credit. But we live in an age of technology now, so each one of the bureaus allows access to your credit report online all the time. So you can go to Experian.com, Equifax.com, TransUnion.com, and pull it up whenever you want to. So for example, Experian.com allows you to see your report and your score with a free account. They have paid subscriptions and other things like that. You have to pay for Equifax and TransUnion as well. But you can also check your Vantage scores for Equifax and TransUnion and see your reports for free on creditkarma.com. And with the paid accounts on the top 3 bureaus, you can get an in-depth look at the various FICO scores from each of the bureaus and some other tools, as long as you have the paid subscriptions. So building your credit can be tricky. If you don't have a credit history, it's hard to get a loan, a credit card, or even an apartment. But how are you supposed to show a history of responsible payment if nobody's going to give you credit in the first place? Well, there are several tools that you can use to help establish a credit history. If your aim is to get a credit card, you could start with a secured credit card or ask to be an authorized user on another person's card. If you want to build credit without a credit card, you might try a credit builder loan, a secured loan, or a cosign loan. There's also ways to use rent, phone, and utility payments to build credit. So let's take a look at each one of these. First, getting a secured credit card. If you're building your credit from scratch, you're likely going to start with a secured credit card. This is a card that's backed by a cash deposit that you make up front. The deposit amount is usually the same as your credit limit. You can use the card like any other credit card. You can buy things, you can make a payment on or before the due date, you incur interest if you don't pay your balance in full each month, and you'll receive your deposit back when you close the account, assuming that the balance is paid in full. Secured cards aren't meant to be used forever. The purpose of the secured card is to build your credit enough to qualify for an unsecured card. That's a card without a deposit and it has better benefits. You can choose a secured card with a low annual fee and make sure that it reports to all 3 credit bureaus. That's Equifax, Experian, and TransUnion. And you can typically get one of these through your bank, or you can check creditkarma.com to see which cards you're likely going to be approved for. Or you can get a credit builder loan or a secured loan. A credit builder loan is exactly what it sounds like. Its sole purpose is to help you to build your credit. So typically, the money that you borrow is held by the lender in an account, and it's not released to you until the loan is repaid. It's a forced savings program of sorts, and your payments are reported to the credit bureaus. These loans are most often offered by credit unions or community banks, and at least one lender offers them online. It's selflender.com. That's SELFLENDR.com, selflender.com. So with Selflender, you're going to pay a small fee up front and then choose the amount of the loan based on the amount that you want to pay each month. They're going to put the money that they loan to you in a CD with your name on it. So you're going to pay monthly until that loan is paid off. They keep the money earned off the CD, and you're going to get whatever the loan amount was at the very end. So this is a really great way to build your credit and save money, especially if you're trying to make a large purchase, because you can use that money to go toward the purchase. Another option, if you have money on deposit at a bank or a credit union, is to see about a secured loan for credit building. With these, the collateral is money in your account or a certificate of deposit. The interest rate is typically a little bit higher than the interest that you're earning on the account, but it's probably significantly lower than your other options. You can use a cosigner, but you need to be sure that the cosigner understands that they're on the hook for the full amount owed if you don't pay. Another way to build credit is to become an authorized user. So a family member or significant other, they might be willing to add you on as an authorized user on their card. Doing so is going to add the card's payment history to your credit files. So you're going to want a primary user who has a long history of paying on time and they have a low utilization rate. You don't have to use or even possess this credit card at all in order to benefit from being an authorized user. So you can ask the primary card holder to find out whether the card issuer reports authorized user activity to the credit bureaus. Some don't, some do, and others report it if it's your spouse. Others will include spouse and children. You just need to check. The activity generally is reported, but you're going to want to make sure. Otherwise, your credit building efforts are going to be wasted. And you should come to an agreement on whether or how you're going to use that card before you're added as an authorized user. And be prepared to pay your share if that's the deal that you strike with the primary card holder. You can also get credit for the bills that you pay. So there are rent reporting services like Rental Karma, and Rental Karma only reports to TransUnion, but there's other ones like Rent Track and others that will take the bill that you're already paying, like your rent, and put it on your credit report. It helps to build a positive history of on-time payments. Not every bureau score takes the payments into account, but some do, and that may be enough to get a loan or a credit card that is going to firmly establish your credit history for all the lenders. Just be sure to do your research. There are some rental reporting agencies that report to all three, and some of them will report retroactive payments, sometimes for the last year or 2 years if you pay their monthly fee for that long, and a registration fee as well. And then lastly, there's Experian Boost. Um, this program offers a way to have your cell phone and utility bills reflected in your credit report with Experian only. You go to experian.com/boost and link your bank account, and it's going to pull from your bank account any of your utilities, so your phone bill or any utilities that are on your bank account statement. And you have to have at least 3 months of payments on those utilities for it to count. Um, this particular service does not report negatives, so you're not going to be penalized for late payments through Boost. We need to practice good credit habits. So building a good credit score, it's going to take time and a history of on-time payments. To have a FICO score, you need at least one account that's been open 6 months or longer and at least one creditor reporting your activity to the credit bureaus in the past 6 months. A Vantage score, this is FICO's biggest competitor, it can be generated a little bit more quickly. You can practice these good credit habits to build your score and show that you are credit worthy. Just make sure you're making 100% of your payments on time, not only with the credit accounts, but also with other accounts like utility bills or bills that you may have, because these bills that go unpaid, they could get sold to a collection agency, which is seriously going to hurt your credit. And if you use credit cards, keep your utilization low. Utilization is the percentage of your credit limit that you use. So I recommend keeping it below 30% on all your cards. Avoid applying for multiple credit accounts close together. Applications for credit can cause a small temporary drop in your score, and multiple applications can cause significant damage. So I recommend spacing your applications out by 6 months. Keep your credit card accounts open unless you have a compelling reason to close that account. Just consider keeping it open. Closing an account can hurt your credit utilization and it's going to reduce the average account age. One of the best ways to earn a great credit score is to always pay your bills on time. So missing one payment can lower your score by as much as 100. So to begin your credit journey, make sure you're paying off all your late payments and don't miss another bill payment. So for example, if I open up a credit card and I have it open for 2 months and I'm late on the second month, my average repayment rate is now 50%. And then it's going to take me a very long time to get up to 95%, 99%, 100% repayment rate. It can take years. So that's why it drops our score so much. If you pay off any old debts, it can raise your score at least 10 to 50 points per debt that's paid off. Again, get a good mix of credit lines, opening a new line of credit or becoming an authorized user, and paying down your debts below 30% of their balance. So, one of the things, we're going to kind of switch gears here. Dave Ramsey is a financial guru, basically, and he has these 7 baby steps to building wealth. And the first one is to create a $1,000 emergency fund. So this is saving $1,000 in an emergency fund. So you're prepared to pay medical or automotive deductibles or anything that comes up. And we want to be saving this money as fast as we can within a month. So depending on how much experience you have on saving, you could be in and out of this step in no time, or you could feel it's impossible. So Dave Ramsey talks about gazelle intensity. So he coined this term after reading Proverbs 6:4 and 5, saying, "Give no sleep to your eyes, nor slumber to your eyelids. Deliver yourself like a gazelle from the hand of the hunter, and like a bird from the hand of the fowler." Because creditors are hunters. They're coming after your money. They're taking your money in the form of interest. We don't want to give that power to them. When you're in over your head with money problems, you need to work as hard as a gazelle works to run from a cheetah. You need that kind of serious, run like your life depends on it action. So that's gazelle intensity. Save your life, or save like your life depends on it. This means no going out to eat, no social life, no Netflix, no nothing. You're cutting off all the extras, trimming all the fat, working a second job, whatever it takes to get that $1,000 emergency fund. So 5 ways to save $1,000 in 1 month is to cut back on your spending. So avoid eating out, cut out the cable, the manicures, the unlimited cell phone data, Starbucks, Amazon Prime, Netflix, all that stuff. Cut it off. You can sell some stuff. Savings should be more important than having things. So you can host a yard sale, sell it on Facebook, clean out your closet and sell it on Poshmark. You can increase your income. So get a part-time job, work overtime. We don't want to be like everybody else because being normal is broke for us. We need to build our wealth. So we're going to gather up all of our loose change and our cash, go dig out the cash underneath the sofa cushions, look for the change in your car console, gather the money out of that old birthday card that Aunt Ida sent you, find all that extra money. That's going to give you a good little start. Then check your tax deductions. In order to get some extra money on your paycheck every month, you might need to look at your I-9 to see if you have excess withholdings on your paycheck. You could be getting a little bit more back each week if you adjust those tax withholdings with your job. Baby step 2 is paying off your debt. So this is getting rid of all of your outstanding debt. Credit card debt, student loans, car payments, whatever. We don't need that negativity in our life, and we don't need that interest in our life. We do this by using the debt snowball. And this is everything except for a house. So the debt snowball says I'm going to pay off all of my debts, starting with the one with the least amount first, and then moving up. And the one with the highest amount I will pay last. So let's say I have a $100 bill, a $300 bill, a $500 bill, and a $1,000 bill. So I'm going to pay off the one for $100 while still making the minimum payments on the $300, the $500, and the $1,000 debts. Then once that $100 bill is paid for, then I can start focusing all of my money on the $200 debt while still making minimum payments on the $500 debt and the $1,000 debt, and so on and so forth until all of the debts are paid off. We're not looking at interest rates here or anything like that. We need to see progress, and the way to do that is to pay these smaller debts off first. If we start to see progress, we'll start to, it's like a reward for us, so we're going to keep going. Baby step number 3 is to have 3 to 6 months of expenses saved. So we're going to add to that $1,000 emergency fund even more money in case we lose our job or we discover a medical issue. So you want to add up, what is my rent or mortgage payment? What are all the utilities costing me on average every month? What is, what do we have that we pay out every month? We want to add that all together, multiply that by 3 or 6, and put that in our emergency fund. Then we move to baby step number 4, which is investing 15%. So we want to invest in our future. We want to have a retirement. We want to know that we can retire comfortably and not have any financial concerns. So what this looks like is investing our 15% in our 401ks, our IRAs, and other investment accounts. We want to start with the 401k, especially if our company matches. We want to make sure that we are maxing out that 401k match. That's free money for us. And then once we reach our limit on our 401k, let's say the limit for the 401k is 10%. Well, I need to be investing 15%. So I'm going to put the other 5% in my IRA. Let's pretend that the 401k max out is 5%. So I'm going to put 5% of my money in the 401k, and then I'm going to put some money in my IRA, but let's say the IRA max is 6%. So now I'm only at 11%. So now I have 3% more that I need to put in other investments. Then baby step number 5, if you have kids or if you're planning on having kids, you want to send your kids to college and remove that burden of crushing student debt from their shoulders. So we want to save up to send those kids to college. Once we've done that, then we can start paying off our house. We can officially become a homeowner. So we're going to do that as much as possible. We're going to make sure that we're still putting our 15% in our retirement accounts, but we're going to keep paying as much as possible toward the principal amount of our home until we pay it down. And on average, typically from the time that we start baby step 1 to the time that we pay off our house is typically about 11 years, depending on how much you're contributing. Then we move to baby step number 7, which is build wealth and give. So you can do whatever you want to, guilt-free. Invest in something, donate to somebody, whatever you want to do. But it's the act of giving back that's going to make you feel happy and healthy and whole, and you have wealth that you can live off of and pass on to your children, and you can live comfortably. So, step one is budgeting. We have to know where our money is going. So, in order to do that, we need to keep track of our money for 30 days. So, this means putting everything on one debit card and monitoring each thing, writing down or putting it in a spreadsheet or an app or something. We want to know where every single penny has gone. And so the way that I usually tell people to do this is put that into categories. So anytime you spend anything on your car, it's going to go under car category. Groceries is going to go into the grocery category. Eating out has its own category. Insurance, taxes, utilities, housing payments, childcare, all of these have their own individual um, boxes, so to speak, on our budget. We want to know what we're spending in each category. That way we can realistically create a budget for the next month. We can look at, oh wow, I spent $400 on eating out this month. Maybe I need to cut back on that so I can invest this $300 in paying down my debts. So I'm only going to spend $100 next month on eating out. We want to make sure that we're logging everything. Another way to do this is if you're paying cash for things, get a receipt for every single thing that you spend and put it in an Excel spreadsheet and just keep track of it. There's several different types of budgets. One is the envelope system where you take an envelope and you write the word rent on it. And each week out of the month, you're going to put money into that envelope specifically for your rent. And you cannot spend that money on anything else. The only time you take the money out of that is to pay the rent. Um, so you're going to have one envelope for rent, one for each of your utilities, one for your car payment, one for gas, one for entertainment. You want to make sure that you're creating envelopes for each category that you know you're going to spend money in. One for eating out, one for groceries, one for childcare, one for clothing. You're going to have to set a limit for each envelope and write the limit on the outside of the envelope. Put that much money in there each month, and that's all you're allowed to spend each month for that particular item. You can use an Excel spreadsheet to create a budget. There's apps out there like Mint or Every Dollar app that will help you to create a budget and help you to stick to it. I like Mint because at the end of the year, it's created by Intuit, so you can put everything over into your taxes if you use TurboTax. Um, just be intentional with your money. Every penny that you have should have an assignment or a name. Um, we want to make sure that we are telling our money where to go, because if we don't tell our money where to go, it has a tendency to fly away. So we want to make sure that we are assigning it a task or giving it a name. I also say this if we're having money in our savings account. What are you saving for? You don't just save to save money. We're saving for something. So give your savings a name. I have $10,000 towards the purchase of a car. I have $20,000 toward a down payment for a house. I have $5,000 for a vacation. I have whatever. Whatever it is that your financial goals are, assign that money a name. Otherwise, it's just going to disappear. And then we want to work on having a zero-based budget. So this doesn't mean you have $0 in your account. It means you've subtracted all of your monthly expenses from your monthly income until the amount left is zero. You've given every dollar a job to do. It's the plan for the month. It's not just a way to track spending your money or whatever you want. It's a way to just make sure you have a solid plan. If you keep going way over your budget or you're not making progress on your money goals, then you really need to buckle down and stick to what you decided that you could afford before the month began. So when I say a $0 budget or zero-based budget, I mean that after all of the bills are paid, you are literally assigning the rest of that money from your income to a specific purpose. So some could go for entertainment, some could go for miscellaneous expenses, and then whatever it is, debt consolidation or debt repayment or um, savings goals or retirement or paying down the house, the rest of that needs to go towards something because you've already budgeted for the things that you need. Now you have to put the rest of that money to work. So here's some numbers you're going to need to know to create your budget. You need to add up all the money that you bring in, and you're going to put that at the top of your budget. This is going to be your paychecks, any side hustles, residual income, child support, any other cash you expect to bring in. If it's money that comes into your household's bank account, that's income. Then you're going to need to know your monthly expenses, every single expense that you have for the month. Most of those are going to fit into categories that I recommended, but you can feel free to make up your own. The best thing to do is just to look at your last couple of bank statements or do the 30 days and make sure you've included everything. Then you can pull out your calendar as you work through this part of seasonal expenses. What expenses do you have coming up that you can start planning for now? Christmas is in December every single year, so it doesn't exactly sneak up on you. Birthdays, anniversaries, car tag renewals, they shouldn't surprise your budget either. So for example, if you're going to spend $500 on Christmas, you need to start budgeting about $40 a month in January. If you start saving in June, that number jumps up to $70 a month. And you need to have a cushion. You're aiming for $0 left in your budget, but that's going to make anybody nervous to have $0 in their bank at the end of each month. Most people leave an extra cushion, anywhere from like $100 to $300 in their checking account that isn't accounted for in their income. When you start this process, budget for that cushion and then try to forget that it's even there. So your first month would have a line under the savings category labeled cushion. You only budget for it once, and every month after it just provides a small invisible buffer to your checking account. And lastly, we want to talk about term life insurance. It's not a fun thing to talk about insurance, but it does need to be a priority. So if something happens to you where you pass away unexpectedly, how is your partner going to pay for monthly expenses without your income? Or how are your children going to be taken care of? In a time like that, we don't want anybody that we care about to have to worry about making ends meet. So the question that's out there is, how much coverage should you actually get? So a 15 to 20 year term life policy that covers 10 to 12 times of your annual income is what you need to take care of your loved ones. Typically, the rule is you want to have 10 to 12 times your annual income for however long it is that your children are going to reach the age of maturity. So I need to plan for, if I have a 17-year-old, I probably don't need to plan for much. But if I have a 1-year-old, I need to make sure that child is taken care of until they're 18. So I need 17 years worth of care provided for them. And most of the time we can get this for the cost of a Netflix subscription or even less. Even if you're a stay-at-home parent, you still need life insurance. There's no one size fits all because every family is different. But a 15 to 20 year policy between $250,000 to $400,000 is a general rule. You have to think about what you're going to do in three major areas: childcare, education, and household duties. So if the stay-at-home parent were to pass away, how much is it going to cost to replace that stay-at-home parent with childcare? How much is the education going to cost? And how much is it going to cost you to hire somebody to do all those household duties that the stay-at-home parent was doing? We need to add all of those together and count how many years out we're going to need those for the kids. That decision is going to mean either getting a bigger policy to cover any extra costs or not. So these are the types of insurance that you can't afford to go without. But there are some types of insurances that you don't need. So if somebody tries to sell you accidental death insurance, mortgage protection insurance, supplemental insurance for medical issues, or whole life insurance, run away. The only thing I will say about that is, let's say you can't get life insurance for some reason. You probably could get an accidental death insurance policy. Um, so that might be an option to look into if you can't get a term life insurance for whatever reason, health issues or whatever. Um, Thanks for joining me. If you have any questions, feel free to ask me in my YouTube channel.